There are more ETFs available in the United States today than there are individual stocks listed on the entire New York Stock Exchange. That number crossed 3,000 exchange-traded funds back in 2022, and it has kept climbing since. You would think that more options means better outcomes for investors. The data says the opposite. The average ETF investor underperforms the very fund they hold. Not because the fund fails them, but because of the decisions made around it. When to buy, when to sell, whether to reinvest, how to combine funds, and most critically, what the fund actually does versus what the investor assumes it does. A Dalbar study tracking investor behavior over 30 years found that the average equity investor earned roughly half the return of the index they were supposedly tracking. Half. The gap is not a market problem. It is a behavior and structure problem. And it almost always starts with a misunderstanding of what an ETF is and what it is not. If you are putting $1,000 a month into an ETF right now, there is a specific set of mistakes embedded in that plan that most financial content will never name directly. That is what this video is about. The first mistake most investors make with ETFs begins before they buy a single share. It begins with a definition. Most people describe an ETF as like a mutual fund, but you can trade it during the day. That description is technically accurate and practically useless. It tells you nothing about why the structure exists, what problems it was designed to solve, or why those design choices create specific risks that do not exist in the funds most people are comparing it to. And if you do not understand the design, you will eventually be hurt by it, not dramatically, not all at once, but steadily, in a way that only becomes visible years later when you compare what your account holds to what it could have held. An exchange-traded fund is a basket of assets, stocks, bonds, commodities, or combinations of those, that trades on an exchange under a single ticker, just like an individual stock. You can buy one share of VOO and own a proportional slice of 500 of the largest companies in the United States. The structure was created in 1993 specifically for institutional investors, professionals managing hundreds of millions of dollars who needed intraday precision and the ability to exit positions in seconds without moving the market against themselves. The retail investor was almost an afterthought in that original design. That origin matters because the product was never fundamentally redesigned when its audience changed. The tool built for people whose entire job is to remain in the market, regardless of what conditions look like, ended up in the hands of people who are emotionally connected to every number on the screen, and who have no institutional obligation to hold when holding feels unbearable. That mismatch is where the first layer of damage begins. What happened next reshaped the entire investment industry. Assets in U.S. ETFs crossed $1 trillion for the first time in 2009. By 2023, that number had grown to over $7 trillion. The structure designed for institutional efficiency became the dominant vehicle for retail investing. And in that transition, a critical problem developed. The flexibility that made ETFs attractive to professional traders, intraday pricing, the ability to short, the ability to buy on margin, the ability to exit a position in seconds, became features that retail investors used in ways that reliably eroded returns. Not because the investors were reckless, because the product was never designed with their behavioral tendencies in mind. Here is the specific mechanism. A mutual fund investor can only transact at end-of-day net asset value. There is no price to watch during the day. There is no temptation to react to a 3% drop at 10 a.m. and sell before the market closes. That friction is not a bug in mutual fund design. It is a feature that protects investors from themselves. ETFs removed that friction entirely. The result, documented consistently across behavioral finance research over the past 2 decades, is that ETF investors trade significantly more frequently than mutual fund investors holding equivalent assets. And more frequent trading, on average, produces lower returns because every transaction is an attempt to time a market that the overwhelming weight of evidence says cannot be timed reliably. The Dalbar QAIB study, which has tracked the behavior gap between fund returns and investor returns since 1994, shows this pattern year after year without exception. The gap is not explained by expense ratios. It is not explained by fund quality. It is explained almost entirely by the timing of investor transactions, by the money that moved in after a rally and out after a drop. The average equity investor, per Dalbar data, has earned returns that trail the S&P 500 by 3 to 4 percentage points annually over multi-decade periods. On a $1,000 monthly contribution held for 30 years, that gap is not a rounding error. It is the difference between financial independence and falling short of it. But transaction timing, as damaging as it is only the first layer of what goes wrong. The second layer is structural, and it is built into the way most people choose which ETF to buy in the first place. The way most people select an ETF follows a pattern that is almost identical across investor profiles, income levels, and experience levels. They search for the best performing ETF over the past 1, 3, or 5 years. They find a fund that has returned 18% or 22% or 28% annually over that window. They buy it. And in doing so, they make a mistake that the financial industry has documented exhaustively, warned about repeatedly, and profited from continuously, because the warning never seems to change behavior at scale. The product that was supposed to democratize investing ended up democratizing one of the most reliable ways to underperform the market. This is called performance chasing, and it is not a character flaw. It is a rational response to irrational information. If you walk into a hardware store and one drill has broken every tool it has touched, you do not buy that drill. You buy the one with the best track record. That logic works in almost every consumer decision you will ever make. It fails, specifically and predictably, in investing. And the reason it fails is rooted in how returns are generated over time, not in how humans think. Past performance in competitive markets is not a reliable signal of future performance. It is a description of a set of conditions that already ended. The market that produced that 22% annual return has already priced in every factor that drove it. You are arriving after the event, not before it. The window that made that return possible closed before you open the brokerage app. And no amount of research into a fund's past performance will reopen it. Here is what the data shows. Morningstar has conducted annual studies on the gap between fund total returns and investor returns, the difference between what a fund earned over a period and what the average investor in that fund actually received. Across every major fund category they track, investor returns consistently lag fund returns. In high-performing equity categories, the gap widens further. The funds that attract the most new money, because they are the ones appearing at the top of 5-year performance rankings, are also the funds where investor timing is worst. The reason is mechanical. Investors arrive after the run-up. They are buying at prices that already reflect years of compounding. And when the inevitable mean reversion arrives, as it does for virtually every outperforming strategy over long enough time horizons, those same investors exit, locking in the loss and missing the recovery that follows. The number shown on your brokerage's fund comparison page is not the return you would have received. It is the return someone else received under conditions that no longer exist. That number is called the time-weighted return, and it measures fund performance as if all cash flowed in on a single date and held without interruption. A scenario that describes almost no real investor. The return that will actually appear in your account is the dollar-weighted return, which accounts for when your specific dollars entered and exited the fund. That number is almost never displayed on the comparison tools most retail investors use. It is a cleaner figure that systematically conceals the most important variable in the actual investor experience: your own timing relative to the market cycle. This is not a minor technical distinction. A fund can post a 12% annualized time-weighted return over a decade, while the median investor in that same fund earns 7%, because the bulk of the assets arrived mid-cycle at elevated valuations, after the performance had already been generated. When you choose an ETF based on its historical return without understanding this gap, you are not selecting a fund based on evidence. You are selecting a number that was produced under conditions that no longer exist, by investors who behaved differently than you will. The correct selection process starts with a different variable entirely, one called concentration risk. And once you understand what it reveals, you cannot look at any fund you currently hold the same way again. The variable almost no one examines before buying an ETF is the one that determines how much actual diversification they are getting. And the answer, in most cases, is significantly less than the fund name implies. This is the concentration problem, and it is a direct consequence of how the majority of ETFs are constructed. Understanding it does not require advanced math. It requires reading one table that is publicly available on every ETF information page, and that most investors scroll past without stopping. The table is called the Top Holdings Breakdown. What it reveals, in fund after fund, is that the word diversification is doing a great deal of marketing work, while the actual underlying numbers tell a very different story. Most broad market ETFs are market capitalization weighted. That means the fund allocates money to each company in proportion to that company's total market value. A company worth $3 trillion receives a far larger slice of the fund than a company worth $30 billion, even if both are included in the same index. The result is that the largest companies in the index dominate the fund's actual exposure, while the hundreds of smaller companies in the basket contribute almost nothing to day-to-day performance. When an investor buys a fund described as holding 500 companies, they are often getting returns that are driven almost entirely by the top 10 to 15 holdings. The other 485 are present in name, but not in weight. The number 500 describes the composition of the index. It does not describe the distribution of risk inside the fund, and confusing those two things is exactly where the concentration mistake begins. Consider what this looked like in practice at the end of 2023. The 5 largest holdings in the S&P 500, Apple, Microsoft, Nvidia, Amazon, and Alphabet, collectively represented approximately 25% of the entire index. The top 10 holdings represented roughly 32%. That means an investor who bought VOO, which tracks the S&P 500 and is one of the most widely held ETFs in the world, had nearly a third of their money concentrated in 10 companies out of 500. The remaining 490 companies shared the other 2/3. This is not a flaw in the fund. It is a feature of how the index is constructed. But it directly contradicts the mental model most investors carry when they describe themselves as broadly diversified across the American economy. And that contradiction has very real consequences when market conditions shift suddenly and without warning. The problem deepens when investors hold multiple ETFs simultaneously, believing they are layering diversification. An investor who holds VOO, QQQ, and a technology sector ETF has almost certainly tripled their exposure to the same cluster of large-cap technology companies because those companies appear at the top of all 3 funds. QQQ, which tracks the NASDAQ 100, had Apple, Microsoft, and Nvidia as its three largest holdings with a combined weight exceeding 20% as of late 2023. The overlap between QQQ and the technology sector portion of VOO is substantial. Adding both to a portfolio does not add diversification. It adds concentration while creating the appearance of variety, which is, in some respects, more dangerous than simply knowing you are concentrated, because it eliminates the moment of honest self-assessment. This matters for a $1,000 monthly contribution strategy because concentration amplifies volatility in ways that are manageable when markets rise and damaging when they do not. In 2022, the S&P 500 fell 18.1% for the year, but the technology-heavy NASDAQ 100 fell 32.6%. An investor who believed they were diversified across multiple ETFs, but whose holdings were overwhelmingly concentrated in the same sector, experienced losses far in excess of what a genuinely diversified portfolio would have produced. The solution is not to avoid large-cap exposure. It is to understand what you actually own before you buy it. And understanding that requires confronting something even more specific: the relationship between what a fund holds and how much it costs to hold it, which turns out to be far more consequential over time than most investors assume. The cost of holding an ETF is expressed as an expense ratio, an annual fee, deducted automatically from the fund's assets, expressed as a percentage. A fund with an expense ratio of 0.03% costs 30 cents per year for every $1,000 invested. A fund with an expense ratio of 0.75% costs $7.50 per year for every $1,000 invested. On those terms, the difference sounds trivial. Over a 30-year investment horizon with monthly contributions of $1,000, the difference is not trivial. It is the kind of number that, when most people see it calculated for the first time, produces a reaction closer to disbelief than indifference. Here is the math. Two investors each contribute $1,000 per month for 30 years into funds that track identical indexes and produce identical gross returns of 8% annually before fees. The first investor holds a fund with an expense ratio of 0.03%, which is approximately what Vanguard charges for VOO. The second investor holds a fund with an expense ratio of 0.75%, which sits at the lower end of what actively managed ETFs and many thematic ETFs charge. After 30 years, the first investor's portfolio is worth approximately $1,397,000. The second investor's portfolio is worth approximately $1,196,000. The fee difference of 0.72 percentage points per year has compounded into a gap of over $200,000 on identical contributions over identical time into indexes with identical gross performance. The only variable was cost. The reason this effect is so large is that expense ratios do not simply reduce returns linearly. They reduce the base on which future compounding occurs. Every dollar lost to fees in year one is not just $1 gone. It is $1 that will never compound again over the remaining 29 years of the investment horizon. The fee is taken before the return compounds, which means the fee's true cost grows exponentially with time. At a short time horizon, the difference is small enough to ignore. At 30 years, it is not. This is why Jack Bogle, who founded Vanguard and spent decades arguing for low-cost index investing, described the compounding of costs as the relentless rules of humble arithmetic. The returns that go to investors are whatever remains after the financial industry takes its share. The expense ratio comparison becomes more complicated when investors move beyond simple broad market index funds. Thematic ETFs, funds built around specific narratives like artificial intelligence, clean energy, cannabis, or cybersecurity, typically carry expense ratios between 0.40% and 0.90%. They also carry a second cost that does not appear in the expense ratio: the cost of narrative obsolescence. Thematic funds are constructed around stories that are compelling at launch and that attract investor money precisely when the relevant sectors are peaking in public attention. The cannabis ETFs that launched between 2017 and 2019 attracted billions in assets at the height of legalization enthusiasm. Most delivered sustained losses over the following 5 years. The expense ratios continued to be charged throughout. The investor paid the fee every year while the narrative that justified the fund's existence quietly collapsed. For a $1,000 monthly contribution strategy, the practical implication is straightforward but requires discipline to follow. The expense ratio is one of the only variables in ETF investing that is known in advance, and certain, unlike returns, which are uncertain, or tax treatment, which varies by account type. Optimizing the certain variable is more productive than attempting to optimize the uncertain one. A fund that charges 0.03% and tracks a broad index gives the investor the market return minus 3 basis points. A fund that charges 0.75% and promises to outperform must generate excess returns large enough to cover that cost before the investor sees any benefit. And the evidence on whether actively managed or thematic ETFs consistently achieve that is not encouraging. But cost is still only part of the picture. The account in which the ETF is held determines how much of the return the investor actually keeps, and that layer is where the $1,000 monthly fix begins to take shape. The account type in which an ETF is held is not an administrative detail. It is a tax decision that, over a 30-year horizon, can produce a difference in final portfolio value that rivals or exceeds the difference produced by fund selection itself. Most investors spend significant time choosing which ETF to buy and almost no time thinking about where to hold it. And that inversion of priorities is one of the most expensive mistakes in the entire chain of decisions that determines what a $1,000 monthly contribution actually becomes over time. The United States Tax Code offers 2 primary structures for tax-advantaged retirement investing: the traditional account and the Roth account. Both exist in 401k and IRA form. In a traditional account, contributions are made with pre-tax dollars, reducing taxable income in the year of contribution, and withdrawals in retirement are taxed as ordinary income. In a Roth account, contributions are made with after-tax dollars, growth is entirely tax-free, and qualified withdrawals in retirement are not taxed at all. The choice between them is a decision about when to pay taxes, now or later, and the correct answer depends on where an investor expects their tax rate to be at the time of withdrawal relative to their current rate. For most working-age investors who expect their income, and therefore their tax rate, to remain stable or rise before retirement, the Roth structure offers a structural advantage that compounds over time. What most investors miss is the compounding implication of that choice applied to ETF returns specifically. In a taxable brokerage account, ETF gains are subject to tax at every step. Dividends are taxed in the year they are received. Capital gains are taxed when shares are sold. Even in a strict buy-and-hold strategy with no trading at all, the drag from dividend taxation alone reduces the effective annual return in ways that accumulate quietly for decades. An ETF paying a 1.5% annual dividend yield in a taxable account held by an investor in the 22% federal tax bracket loses roughly 0.33 percentage points of return per year to dividend taxes alone, before any capital gains taxes are applied on eventual sale. Over 30 years, that drag compounds into a meaningful and permanent reduction in terminal portfolio value. The structure becomes even more consequential when comparing a Roth IRA against a taxable account for the same $1,000 monthly contribution held over 30 years at an 8% gross annual return. In the taxable account, assuming a blended effective tax rate of 15% on investment returns throughout the holding period, the after-tax portfolio value at the end of 30 years lands near $1,150,000. In the Roth IRA, where growth compounds entirely tax-free and qualified withdrawals carry no tax liability, the same contributions and the same market return produce a portfolio value near $1,397,000, every dollar of which is accessible without further tax obligation. The gap of nearly $250,000 is produced entirely by account structure, not by fund selection, not by contribution size, not by market conditions, by where the ETF was held. The practical implication for a $1,000 monthly contribution strategy is a specific sequencing rule that most investment content skips entirely. Maximize tax-advantaged space before directing any money to a taxable account. The 2024 contribution limit for a Roth IRA is $7,000 per year for individuals under 50, roughly $583 per month. The 2024 401k contribution limit is $23,000. For most investors contributing $1,000 per month, the priority order follows directly. Fill the Roth IRA first, then contribute to the 401k at minimum up to the employer match, and only then consider the taxable brokerage account. The ETF held inside the Roth IRA and the ETF held in the taxable account can be identical in every way. The account structure alone determines whether the government is a silent long-term partner in the portfolio's compounding, or a permanent beneficiary of it. But even with the right account and the right fund, there is one more variable that most investors never address, and it is the one that ties everything together. The variable that ties everything together is the one that sounds the least sophisticated and is, in practice, the hardest to maintain consistently over years and decades. It is contribution consistency. The mechanical discipline of investing the same amount at the same interval, regardless of what the market is doing, what the financial news is reporting, or what the portfolio's current balance looks like on any given day. This is dollar-cost averaging in its correct form, and it is important to be precise about what that means, because the term is used so loosely in most financial content that it has lost much of its practical meaning. Dollar-cost averaging is not a strategy for picking entry points. It is not a method for reducing risk in a single lump sum purchase by spreading it across several months. In its most powerful form, it is an ongoing contribution discipline, a standing instruction to invest a fixed dollar amount on a fixed schedule, executed automatically without any discretionary input from the investor at the time of purchase. The reason this structure matters is that it eliminates the most destructive variable in the entire ETF investment process, the investor's emotional state on the day money moves into the market. When the decision to invest is made once, at setup, and executed automatically thereafter, there is no opportunity to second-guess, delay, or redirect the contribution based on conditions that feel alarming, but that the historical record consistently suggests are irrelevant to long-term outcomes. When contributions are automated, the investor buys more shares when prices are low and fewer shares when prices are high. Not because they predicted anything, but because the math of a fixed dollar amount applied to a variable price works that way automatically. Over time, this produces an average cost per share that is lower than the average price per share over the same period. That gap between average cost and average price is the mechanical return that dollar-cost averaging generates on top of the market's underlying return. It does not require skill. It requires only that the investor not override the system during the months when overriding it feels most justified. The months when overriding it feels most justified are exactly the months when maintaining the system produces the greatest long-term benefit. March 2020, when the S&P 500 fell 34% in 33 days, was the month when an automated $1,000 contribution bought more shares of VOO than any other month in the preceding 2 years. The investors who paused their contributions during that drop, and survey data from multiple brokerages suggests a significant percentage did exactly that. Bought fewer shares at lower prices than investors who did nothing. They then faced a secondary decision: when to resume. Many waited for confirmation that the market had stabilized. The S&P 500 recovered its February 2020 high by August 2020, 5 months later. Investors who paused during the drop and resumed only after the recovery had confirmed itself missed the entire correction to recovery cycle, the most productive period for new contributions in a decade. This pattern has repeated in every significant market decline across the history of index investing. The investors who benefited most from dollar-cost averaging were not the ones who made better predictions. They were the ones who made no predictions at all, who treated the monthly contribution as a fixed obligation, indifferent to current conditions, and whose accounts were structured so that the transfer happened automatically before the investor had any occasion to reconsider it. The $1,000 monthly fix is not a particular fund. It is not a specific account type, though the account type matters enormously. It is the combination of low-cost, broadly diversified holdings, held in tax-advantaged accounts, contributed to automatically and without interruption across market cycles. What that combination actually produces over a 30-year horizon, and why the terminal number surprises most people who calculate it for the first time, is what the next part of this analysis addresses directly. The math of a correctly structured $1,000 monthly contribution held over 30 years is worth examining in full, not as a projection of future market performance, which cannot be guaranteed, but as a demonstration of what the variables covered in this analysis actually contribute to the final outcome when they are handled correctly versus incorrectly. Most people who have heard the advice to invest $1,000 per month have never seen the complete accounting of what that means, what the number becomes when every decision in the chain is right, and what it becomes when the common decisions are wrong. Start with the baseline. An investor contributing $1,000 per month for 30 years at a gross annual return of 8% accumulates approximately $1,397,000, assuming contributions compound without interruption and fees are minimal. Total out-of-pocket contributions over the period are $360,000. The remaining $1,037,000 is the return generated by the market and by the compounding of prior returns, money that was never contributed, but that the portfolio produced entirely on its own over time. This is the foundational number. Every decision in the chain either adds to it or subtracts from it, and the size of those additions and subtractions is consistently larger than most investors expect when they see them quantified together for the first time. Now, apply the mistakes identified in this analysis and observe what happens to that number. An investor who holds a fund with a 0.75% expense ratio instead of a 0.03% fund loses approximately $200,000 to compounded fee drag over the same 30-year period. An investor who holds the fund in a taxable account instead of a Roth IRA loses an additional $200,000 to dividend and capital gains taxes, assuming a blended 15% effective rate on investment returns. An investor who pauses contributions during 2 significant market corrections, say for 6 months each time, which is a modest and well-documented estimate of typical investor behavior, loses the compounding benefit of contributions made at the lowest prices of the decade, which at 8% over the remaining years amounts to approximately $55,000 in foregone terminal value. An investor who chases performance and rotates into a thematic ETF that underperforms the broad market by 2% annually for 5 years. Before rotating back, loses an additional $80,000 to $100,000, depending on when in the cycle the rotation occurred. Add those subtractions together. $200,000 in fees, $200,000 in taxes, $55,000 in missed low-price contributions, and $90,000 in performance-chasing losses. The investor who made all 4 of these mistakes, each of them common, each of them documented across large investor populations, ends the same 30 years with approximately $850,000 instead of $1,397,000. The contributions were identical. The time horizon was identical. The broad market return was identical. The difference of over $500,000 was generated entirely by the decisions surrounding the investment, not by the investment itself. This is what the 90% figure from the opening of this video actually represents. Not investors who failed to find the right fund, but investors who made correctable structural errors around funds that would have served them exceptionally well if simply left alone. The final layer that this analysis has not yet addressed is the one that makes every prior decision either durable or fragile over time. What happens to this system as retirement approaches? The accumulation phase, 30 years of monthly contributions compounding inside tax-advantaged accounts, is the part that most financial content addresses at length. The decumulation phase, the transition from building the portfolio to drawing regular income from it, is the part that almost none of it explains in structural terms, and where a different and equally consequential set of decisions waits. The choices made in the 5 years before and the first 5 years after retirement can undo decades of disciplined accumulation in ways that are as structural and as preventable as everything described here. That resolution, the one this analysis has been building toward, is next. The decumulation problem, the transition from accumulation to income, is where the structural errors shift. During the accumulation phase, volatility is an advantage. Market drops lower the price at which automated contributions buy shares, which improves the average cost basis over time. In the decumulation phase, that relationship inverts. When the portfolio is being drawn down rather than built up, volatility becomes a risk with a specific name: sequence of returns risk. It refers to the danger that a significant market decline occurring in the early years of retirement, when the portfolio is at its largest and withdrawals are beginning, can permanently reduce the portfolio's ability to sustain those withdrawals over a long retirement. The mathematics of this risk are not intuitive. 2 investors with identical 30-year retirement portfolios of $1,397,000, withdrawing at the same annual rate, can end up with dramatically different outcomes, depending solely on whether the large market declines in their retirement occur early or late in the sequence. An investor who experiences a 30% decline in year 2 of retirement while withdrawing $50,000 per year may exhaust their portfolio 12 to 15 years before an investor who experiences the same total decline spread across later years. The returns are identical in aggregate. The sequence is different, and the sequence is the variable that determines whether the portfolio lasts. The fix for sequence of returns risk is not to move entirely into cash or bonds at retirement, a strategy that has historically produced its own form of portfolio failure through inflation erosion. It is a structured allocation shift, executed gradually in the 5 to 7 years before retirement, that reduces equity concentration without eliminating growth exposure. The standard framework used by financial planners is a glide path. a schedule that progressively shifts the portfolio from high equity allocation toward a balanced allocation of equities and fixed income as the retirement date approaches. Target date ETFs automate this process for investors who want a single fund solution. For investors managing the transition themselves, the principle is the same. Begin reducing the proportion of the portfolio exposed to short-term equity volatility before withdrawals begin, not after the first large decline arrives. Taken together, the complete answer to why 90% of people get ETFs wrong is not a single error. It is a sequence of individually understandable mistakes, each of which compounds the others. The investor who buys a high-cost thematic ETF based on recent performance holds it in a taxable account, pauses contributions during corrections, and makes no allocation adjustments approaching retirement has not made one large mistake. They have made 5 medium ones that interact with each other and with time to produce an outcome far below what the same contributions in the same market over the same horizon would otherwise have generated. The fix is not complex. It is specific. Low-cost, broadly diversified index ETFs held inside Roth IRAs and 401ks as the first priority, contributed to automatically on a fixed schedule without interruption, with a deliberate glide path toward lower equity exposure as retirement approaches. That is the $1,000 monthly fix nobody explains. Because it is not a product, it is not a service, and it does not generate a fee for the entity that describes it. If you've made it this far with me, I want to invite you to subscribe to our channel and follow along every day. The topics covered in this video: tax structure, fund selection, behavioral discipline, decumulation strategy, each deserve their own full treatment, and that is exactly what this channel is built to provide. If this analysis was useful to you, share it with 5 people who are contributing to an ETF right now and have never seen the full cost of the decisions surrounding that contribution laid out in one place. Leave a comment with the mistake from this list that you have made yourself, or the one you came closest to making. And tell us what topic you want this channel to address next. The information that changes financial outcomes is rarely the information that gets the most attention. That gap is what Bedrock Money exists to close.